Well, good afternoon, everyone, and welcome to our Monday webinar. We're going to put the spotlight on Stan Freifeld of McMillan and Associates. McMillan Asset Management. How could I ever make that mistake? I do apologize, Stan. Stan has over 30 years of experience in derivatives training, risk management, and client services. After graduating from the State University of New York at Stony Brook as a double major in pure and applied math, he became one of the youngest members of the prestigious Society of Actuaries. Prior to trading options for his own account as a market maker and a floor official on the American Stock Exchange from 1994 to 2001, he was a principal of a pension consulting firm. We're very happy to have Stan with us today. As you may know, that his boss, Stan's boss, Larry McMillan, actually wrote the book on options trading. Options as a Strategic Investment is a bestseller. It was published in its first edition 35 years ago and now has over 300,000 copies and is commonly referred to as the Options Bible. We're hoping Stan can straighten out a number of our option misconceptions today as we talk about whether we should buy options or whether we should sell them. My name is Don Prattle, and I'm the Director of Education here at TradeStation, and I want to welcome everybody for attending our webinar today. Before we turn things over to Stan, I want to remind you that our presentation is for educational purposes only. All the symbols, all the trading ideas, and everything we discuss here are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Remember that active trading may not be suitable for you because, well, it's not suitable for everyone. And options trading carries a high degree of risk and may not be suitable for all traders. We've included in the chat panel a couple of pieces of disclosure information regarding the characteristics and risks of standardized options, as well as another document with the asset classes and their disclaimer documents that we cover here at TradeStation. I urge you to please read that disclosure information at your convenience. By clicking on them, you will open another window to be able to read them, but read them at your convenience. So this brings me to a rather unusual screen that Stan has created with a little quiz. I'll turn things over to him right now. He can begin to administer to you, his students, the parameters for this quiz. And Stan, thanks so much for spending time with us today to talk about options trading. It's one of our favorite topics here at TradeStation.
Hey, Don. Thank you for having me. Thank you for allowing me to speak to your group. I know that it's a group that likes to trade options, and you have people in your group at various levels. And I'm going to try and give some basic but very useful information about trading options. Let me just tell you what this is about. Sometimes people sign into these webinars a little bit early. I don't like them just looking at a blank screen that has my name on it or something like that. So I give a few brain teasers. It's my standard method of operation. And for those who've responded, if you got two or all three correct, I'll get in contact with you later on, but you'll receive a free 3-month trial subscription to the Options Strategist. That's our flagship newsletter. And I'll give the answers to these for people who are still looking at them later in the webinar. Okay, but now we have a lot of material to cover, so let's get to it. And here's what we're going to talk about. We're going to talk about the difference between buying and selling options. You're going to hear a lot of people saying the only way to make money is by buying options or by selling options or by doing this or by doing that. And the truth is, at least from my perspective, there's lots of ways to make money trading options, but it's a complicated asset that we're trading, and I think we have to be careful. Okay, so with that, really brief introduction. And before I forget, I want to thank you, Don. I already said for having me, but I want to thank TradeStation in general for putting on webinars like this. I think it's very helpful to the public traders um, who who might not understand options all that well. Um, they options are a little bit different than stock. Stock and some other assets just go up or down. With options, we have a couple of extra dimensions, that time and volatility, that add a bit of complication to the picture. And the truth of the matter is, that's actually good for those who take the effort to learn how to trade them, because most of your competition doesn't understand those things. I run a mentoring program. I'm teaching people how to trade all the time. And to me, I find it so interesting how somebody will try to save $50 on a TV set. They'll run to 3 different electronics stores to save some money. But then they'll put $3,000 or more or something maybe less, but they'll put a lot of money into a position, an options position, and not really understand. They don't know if time going by is good for them or bad for them. They don't know if they want the stock to go up or down. They don't know if an increase in volatility is good. What about dividends and interest rates? And to me, it's amazing. So TradeStation, we have a shout out to them because they're great in terms of having these webinars. But okay, but let's talk about the difference between buying and selling options. So first, here's my contact information. I like talking about options. It's maybe I need more of a life. I don't know. But it's what I do during the day. I trade options. I teach people how to trade options. And then at night, what do? I'm watching or doing a webinar or reading information about options. So the family joke, at least, is that I need more of a life. I'm also into cars a little bit, but that's another story. Here's my contact information. Uh, you could call me. I like talking to option traders. Um, and I'm always willing to have a chat with people. This is a direct number. It comes to me. I might not pick it up right away if I'm mentoring or trading, but I'll always get back to you if you leave a message. And here's my email. It's Stan, my first name, at optionstrategist.com. Okay? All righty. So what we're going to talk about today is buying and selling options. I put together an outline of the presentation. First, I have my own disclaimer. It's probably similar to what Don read. I'll tell you a little bit about who I am. I'll give you some background information, and then we'll really get into it. The reasons why some people say you're better off selling than buying options. And we'll go through each of these reasons. I have 5 that I have listed here. I'll state what they are. I'll state why people and traders believe that they're true, and then I'll give some perhaps counterexamples. Oh, excuse me. I'll give you some final thoughts, and then I'll tell you a little about McMillan Analysis Corporation. That's what MAC stands for. And we have some specials for those who are attending today. All right, here's my disclaimer, and I'll read it real fast. The presentation is for educational and informational purposes only, should not be construed as a solicitation to buy or sell options or other securities of any kind. We are not advising or recommending the use of the strategies or techniques described herein. There are multiple risks inherent to options trading that may expose investors and traders to potentially rapid and substantial losses. You agree that McMillan Analysis Corp. and Stan Freifeld, of course, right, is not liable for any trading losses or other consequential damages you may incur. And as Don already pointed out, option trading is not suitable for everyone. To learn more about the risks of trading options, see the brochure by the Options Clearing Corporation. It's the one that Don showed you earlier. Okay, so let's start. Oh, well, let's almost start. First, here I am. This is when I was on the floor of the American Stock Exchange. I keep using this picture because I had hair back then. although it's starting to go. But anyway, the basic idea is I was a market maker on the Amex from 1994 to 2001. I was there till 9/11, by the way, and then I left. Seven guys on the floor were actually killed that day. I never went back, um, but I became an official of the floor after being a market maker. And that was kind of interesting because I was able to referee certain trades. And what would happen is one side, if you went in their favor, they were very happy with you. The other side that you um, decided against, they weren't very happy because a lot of money sometimes could be involved. But anyway, as long as you were honest, it made it a relatively easy job to do. Before starting trading, I was an actuary, in particular a pension actuary. There are different types of actuaries. And Don told you I was a double major in pure and applied math. What else? That's really it. I'm in New Jersey. I play, well, actually I don't play so much anymore, squash. I do road rallies in my sports car. And I used to, and again, I haven't done this very much recently, tutor the local high school students for the SATs. Math only, by the way. They wouldn't want me tutoring for English. Okay, that's really it. Actually, I said I'm in New Jersey, but next month we're moving south to North Carolina. Escape the cold. Getting too old for cold weather. Okay, so now let's actually get into the presentation. First, just some basic information about options. I'm sure most of you know this, but there are four basic option positions. We have the long put and long call, and we have the short put and short call. And the characteristics of long options is that there's a limited loss and the potential for unlimited gain. When I say unlimited gain with the put, obviously a stock can't go to less than zero, um, but it's still there's a potential for a pretty large gain with the put if the stock goes in the right direction, which of course would be down. This is the most we could lose. The most we could gain is whatever's above this break-even line. Um, I normally have my own color coding. I like a green break-even line, but this is what we have. So I'm making money above the break-even. Same thing over here. The horizontal axis is stock price. So all I could lose, all that I am below the break-even, is what I paid for these options. So that's the characteristics of a long position. The characteristics of a short position is kind of like this one. And that is the most we could make now. Now we're short. We're shorting puts and we're shorting calls. And the most I could make is what I sell it for. That's kind of interesting. The loss is unlimited. Again, there's a maximum loss if you're selling a put, but it could be pretty substantial. The maximum loss on a short call actually is unlimited. There's no upper limit to where a stock can go. Well, at least theoretically, right? We're not going to have a $50 stock go to $2 million or something. Probably not. Okay, so it's interesting, though, to see the different characteristics. So we have, for long positions, limited loss and unlimited gain potential. And for short positions, puts or calls, we have limited gain and unlimited loss potential. Okay. All right. Now, the purpose, the reason I decided to do this kind of a webinar, I've been doing it for this particular one for a while, is because I see people saying that it makes more sense to sell options than to buy options. And you've probably heard that. And I just want to go through the reasons. So let's see what we have here. So it's commonly written and common to hear that it's better to be an options seller rather than a buyer. In some market conditions, the strategy could be very profitable. Other times it could lead to disaster, right? We know there's unlimited loss potential when we're selling options. And what I'm going to do today is go through the top 5 reasons. I actually have a couple more that I haven't added, but the top 5 reasons that are usually given for being an options seller as opposed to an options buyer. All right? So I think it's also important to know where profits come from before we get into the 5 reasons. And, you know, it's actually, it's pretty simple. When you make a profit, there's somebody else out there who's losing money on that trade. You both can't make a profit on a buy or sell of an options position. If I buy and you sell, if I make money, you're going to lose money, and vice versa. This is referred to as a zero-sum game, meaning we're not creating anything. Well, I say that over here, but we're not creating anything. It's not like a baker. You know, think about a baker. They take all these ingredients, they put them into a pot, stir it up, bake it, I guess, and they come out with a cake that's worth more than the sum of the ingredients. We're not doing that. We have options, and if I make money, you're losing. If I lose money, you're making. And in fact, perhaps it's even worse than that. Some would call it a negative sum game because we have expenses. So out of the pot comes these expenses that we're paying, and so we're in competition. See, I think of options as a very competitive environment to be in. We're in competition, and by coming to webinars and learning about how options really work, it's going to give you a leg up on a lot of the competition out there. So the question is, are option sellers smarter than buyers? My answer is no, not necessarily. And let's take a look. So the first reason that you hear is that options decay and time always moves forward. You know, ka-ching, let's ring the cash register here. Well, let's look into it perhaps with a little more detail. True, yes, time decay benefits option sellers. If nothing else changes, the value of an option tomorrow is worth less than the value of the option today. And if you sold it, you could buy it back at a cheaper price. Okay, that makes sense. And yes, time is always moving forward. Okay, those two things we can't argue with those, right? However, there's other things that are going on that impact the value of an option. We have the stock price, obviously. And what about implied volatility? These are really important determinations or variables that determine the value of the options. And so you have to take them into account as well. And the question that I ask is, do you think buyers don't know about, number 1 and number 2 here? Well, the truth of the matter is they do. And you're going to see some interesting examples as we go on. Okay? All right. Well, that's an easy one to kind of debate. But the next one's maybe a little more interesting. It says casinos sell bets, and they've built some pretty nice hotels, right? With the money that they're making. Well, let's take a look at that. So the way I'm going to do this, we'll examine roulette. Most of you probably know what roulette is, but let me just tell you, a typical roulette wheel, at least in the U.S., has the numbers from 1 to 36, and then also a 0 and a 00 for a total of 38 numbers. You bet on a number, a particular number, and if that number comes up when they spin the wheel, you're going to win 35 to 1. There are other types of bets. There are 18 of the numbers are red, 18 are black, and you also the 0 and 00 that I just mentioned, those are green. And you could bet on red or black, and in that case, the winning payoff is going to be 1 to 1. Excuse me, I'm getting over a respiratory infection. Other bets are also available, and the concept is really the same, though. So the casino is selling the bet, and the player is buying the bet. Okay, let's see. So what we have to understand to examine this is mathematical expectation. Mathematical expectation is something that mathematicians and traders and gamblers, people use all the time. And mathematical expectation is equal to the sum of all the wins and losses multiplied by their probability of occurring. So how do we do that? Well, here's what it would be. The probability of winning times the winning payoff plus the probability of losing times the amount of the bet. That's the amount that we would lose. So from the player's perspective, the odds on hitting a particular number, let's assuming that they're betting on a particular number, the odds on hitting it, since there are 38 numbers, is just 1 out of 38, and they're going to win $35. The probability of losing is 37 out of 38 times. Your number won't come up most of the time, 37 out of 38. You're going to lose $1, or we could call it a unit, but let's assume these are dollars. And so if you multiply these two numbers together and add them up, you're going to get a negative 5.26%. All right? Now, from the casino's perspective, most of the time they're going to win. Your number is not going to come up. They're going to win the dollar that you bet, and every once in a while, 1 out of 38 times, they're going to lose $35. But when you put these numbers together, their mathematical expectation is a positive 5%, 5.25, just about, a little more than 5.25, actually, 5.26%. Okay, but is it because the casino is selling the bet that they have this higher mathematical expectation? I don't think it is. Here's one way that we could think about what's going on from the buyer's point of view, from the player's point of view. Their life cycle is going to look something like this. They're going to lose most of the time. You know, lose, 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 lose. Then they're going to win real big. See my big W here? They're going to lose, 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 $1, $1, $1, and then win $35. From the casino's perspective, it's just the opposite. They're going to win most of the time, but they're going to have some large losses. They're going to continue to win, then they're going to have losses. But still, it doesn't explain which one is better, right? Well, let's see if we could figure it out. Well, excuse me. The payoff, we said, is, from the player's perspective, is a loss of 5%. Okay. Now, if the payoff, instead of being 35 to 1, was 37 to 1, and we did the same calculation, the player's expectation now would be 0, meaning it would be a totally fair game. The life cycles would be the same. In other words, the player would still lose, 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 win real big. Now he'd win a little bit more. He'd win 37 instead of the 35. And the same thing for the house. They would continue to win most of the time, but overall, now it would be break even. In other words, if the player did it long enough, he would break even. And if the payoff was 38 to 1, and believe me, something like that would never happen, now the player would actually have the positive expectation. And you could see, because if it's 38, the probability of winning is 1 out of 38. Probability of losing is 37 out of 38. And now if you put this all together, you'd see the player has a positive expectation of 2.63%. And those casinos would start coming down very quickly. But it's never going to happen. So what we could see is that the reason that the seller has the advantage here, and it's going to be the same thing for options, is because the mathematical expectation is on the seller's side in this particular situation. There we go. So the player is playing a game, when we're talking about roulette, the player is playing a game stacked against him, or her, I guess, but not because he's a buyer. It's because of the negative expectation. And that's really the key to the point that I want to make today. To make it a fair game, the payoff should be 37 as opposed to 35 to 1, 37 to 1. Alternatively, another way to make it a fair game, you could go through the numbers if you'd like, but if the bet was 95 cents, 94 and 3/4 cents instead of $1, then with a payoff of 35 to 1, you could do the calculation. You could see it would still be a fair game to the player. But the way it is now, it's rigged against you. All right, there we go. Here's a good one. Market makers sell options, and they're the smart money. I was a market maker. I don't know if we were the smart money. We were. Our advantage came from buying on the bid and selling on the offer. Um, but here's some facts about market makers. This is my perspective of having done it and then having been an official of the American Stock Exchange. It's true, market makers do sell more than they buy. All right, why is it? You think market makers want to do that? Well, here's the truth of the matter. Market makers are reactive to public order flow. Most of the public buys options. In fact, most of the public is not even able to sell options. Maybe for covered calls, but they can't sell options for purposes of naked puts or naked calls. You need a relatively high approval level to be allowed to sell options. So most of the public order flow is buying options. Well, guess who the market maker is? The market maker is the other side of the public order flow. So if the public is buying, the market maker has to sell. Now again, that's not necessarily why market makers are making their money. They're buying on the bid, they're selling on the offer, but they're reactive to public order flow. And that's very important to understand. There are market makers who really like to trade from the short side. And here's my comment on that. It's particularly those who are trading someone else's capital. When I was on the floor, I was trading Stan Freifeld's capital. So I didn't have the largest account in the world, but I'm standing next to guys who are being financed by brokerage companies, and they had almost unlimited capital. And their pay structure, or their bonus structure at least, was based on how much money they made while they were trading. So they were in a position to take shots, because the worst case scenario would be, well, we lose a lot of money. Okay, no big deal. So you might get fired from that particular position, and you go find another broker who's willing to hire you to trade options for them. But if you're trading your own money, and those are typically called locals, that's what I was, then you have to be a bit more careful. So we didn't want to have positions that were overly short, and we try and adjust our pricing so that we could buy options as well as sell options. Most market makers try to hedge their positions and are very aware of their short gamma. I'm not sure if everybody knows what I mean by that, but gamma is very important, and the way you get positive gamma is by buying options. The way you get negative or short gamma is by selling options. And if you have a short gamma position, you could be at risk to large moves of the stock. Large stock movements could cause you problems, particularly if the options that you're selling are near term as opposed to far term options. So keep that in mind. Okay. Oh, excuse me. Sorry for that. Next, the next reason here. Sellers have to be compensated because their risks are unlimited. Okay, well, we know that to be true. When you're selling something, you have unlimited risk. Well, how do you know? How do you know if you're being properly compensated for the unlimited risk that you're taking when you're selling an option? Well, the only way to really measure it is to determine if there's an edge. And if you think that there is an edge, where do you think it's coming from? Are the buyers overpaying? Well, that's what it must be. And how much is the right price to sell an option for? How do you make that determination? Most of the mentoring I do now is over the internet, but I've done some brick and mortar type mentoring to a class. And when you have a class, I'll give some information. I'll ask, is anybody willing to buy this option? Put up the IBM 150 calls or something like that. And is anybody willing to sell this option? We find two people willing to buy and sell. And then I say, all right, what price are you willing to pay and what price are you willing to sell? And when you get into that kind of a conversation, you find that, people tend to, well, not the sophisticated traders, but people tend to go on gut. And gut is not a way to trade options. So you really need some kind of a mechanism to determine if your options are properly priced. Are they overpriced, underpriced, or priced just right? And the way I like to do it is I like to look at volatility. Of course, I'm a volatility trader. For those of you who don't, who aren't aware of me and haven't heard me speak before, I try to not predict direction. In fact, my whole concept is to take the directional component out of the strategy. So, and in fact, let me just talk about that for a minute, because you'll find it interesting if you're not familiar with this concept. Basically options are, the option prices are determined by three main variables. And those are stock price, time to expiration, and volatility. There's also interest rates and dividends, I know that. But the three I mentioned are probably the most important of the variables. Okay, now time only goes in one direction. It's very easy to predict. If there's 30 days to expiration today, I know, I'm pretty sure there's 29 tomorrow, 28 the next day. Every day it's one day less. So I could predict how many days there are to expiration very easily. Now think about this. If I could take the price out of the equation, now you can't do it completely. I mean, it's not an exact science. It's not a perfect science. But if I could take the directional component out of the equation, that leaves me with just volatility. And that's why I'm a volatility trader. And I look for situations where volatility is low and I want to be a buyer, or where volatility is high and I want to be a seller. Now it's not, it's not as easy as I'm making it sound. Option trading takes work. There's no, no silver bullet or special sauce, they say. But that's the concept of being a volatility trader as opposed to being a directional trader. So, the question is, sometimes you would take an unlimited risk, right? You drive a car, your risks there. You could have an accident, you could get hurt, or worse. You cross the street, same thing. So at some, for some reason, you're willing to take these unlimited risks, but but you have to make sure it's worthwhile. You might not cross a 6-lane highway where the cars are going at 70 miles an hour, right? But you would cross your local street. And so we're looking at the risk and the potential reward that you get from that. So it does make sense, but to take an unlimited risk sometime, but you want the probability of danger, of severe losses, catastrophic losses, to be relatively small. I want to show you an example of a situation that might bring home some of these things. So we had on August 18th of 2015, 3 years ago, we had SPX at 2096 and change, 92. The September 1695 puts, now here we are in August, so about a month out, have the exact date on the next page. The September 1695 puts with 25-cent bid offered at 35 cents. So the question is, would you sell these? Now, there was actually somebody who was advocating, being a seller of these things. Look how far SPX would have to go. You're saying, wow, let's call it 1700 to 2100, about 400 points. That's a big move in about a month, right? So would you sell these? Well, let's take a look at what actually happened. So if we sold them, all we'd get is a quarter. And by the way, to make this work, to make a living doing this, or to make any real money doing it, you'd have to sell, a significant number of them. And there's margin requirements. You need a relatively large account to be able to do it. But let's say, you go out, you sell 20 or 50 of them, something like that, to bring in some monthly income. We're selling them at 25 cents. All right. Well, guess what happened? SPX never got to that level. So if we were able to hold on to them, they would have expired worthless, and we'd keep our 25 cents, however many times we did it. But look at what happened. So I think we were at 815. Well, on 819, SPX was 2079. Now they've gone up a little. And if we wanted to get out of the ones we sold at a quarter, we'd have to buy them back at 50 cents. And so if you have some good discipline, you might have done that. But a lot of people would not. They'd just say, okay, it's pretty far from, what was it, 1700, right? It's never going to get to 1700. That's more than 379 points. It's not going to get there. All right, so you hold it another day. Now all of a sudden it's 75 at $1.20. Now remember, we sold them for a quarter, so we'd be losing almost $1 if we bought them back. And yes, I know, maybe we could buy them back at $1, somewhere midpoint, mid-price between them. But again, you say, all right, the market's coming back. I'll just wait. I'll wait another day or so. Well, look what happened now. Now it's continuing to drop, but it's not even severe drops. I mean, 40 points, I guess, is not insignificant, but it's not crazy. It's not ridiculous. Now what do? Now they're 870. All right, maybe you could do it for 8.25, something like that. Well, remember, you sold them for 25 cents. Now you're really up the creek. Now you don't know what to do. Should you buy them back? Because you don't know, how low the SPX is going to go. But on the other hand, you're going to lose a lot of money. If you did it even 10 times, that's well, let's say you paid $750, so you're losing 7.25. At $725, that's $7,200 that you'd be losing by buying them back. And let's say, all right, now we get to a weekend. You wait till Monday. Look at what we have now. Now, if you want to buy them back, we're talking $27. That's 100 times what you paid for, what you sold them for originally. Yeah. Oh, and somebody, I just see in the chat here, somebody said that we'd have a margin call. That's probably correct. In fact, you might not even have a choice of being able to hold it. Now, the point is, if you did hold it, it would have worked out. And when I see people explaining this kind of strategy, they just say, yeah, and they would say, all right, in September 2015, the strategy worked. I sold them for a quarter, or maybe you sold them, the next day for 50 cents even, and they expired worthless. Well, that's very good. But the point is, what do you do in between when you're faced with this kind of a situation? And the answer isn't easy. It's very hard. Here you could say, all right, I'll take the loss. But if you didn't, the next thing, now you're in trouble. Over here, now you might say, and I hear people saying this kind of thing all the time, say, well, I'd lose too much if I buy them back. Now think about that logic. The next day, they're $20 more, $2,000 more per contract. Now you're really having a catastrophic loss. And it takes away your whole year, maybe a lot more than that, depending on where you decided to get out. So it's not just Would the strategy have worked if I held to expiration? Lots of times you'll see people proving that it works by going to expiration. But in between now and expiration, there's a lot that could happen in between. For those of you, I think there are some students of mine in the audience. You probably heard my story about sell the 280s and buy a Mercedes. And it's I can't go into it right now for everybody, but it's the same kind of thing where if you just look at the results, yes, it would have worked. If you looked at would it have been reasonable or even possible, as somebody said about the margin, would it have been possible to hold the position? Well, the answer is probably no. Okay, so be careful when you see things that try and say they're proving something. Make sure you get all the details. All right, and now we're going to get to what I think is, probably the best reason to talk about, and that is fill in the number over here. 75 to 90% of options expire worthless, and that's why you have to be an options seller. That's what you're going to hear. Now let's go through that. The the argument is based on an article that contains, in my opinion, and others as well, a misinterpretation of a study that was done by the CME covering the period 1997 to 99. It really picked up traction, though, because there are people who like to convince you that selling is the only way to make money. But the study found that approximately 75% of options held to expiration. So they don't make it that clear when you hear that 75% or 90% expire worthless. They have to held to expiration, expire worthless. From that, some have extrapolated it's better to be a seller than a buyer. All right. This is a quote. I just wanted to show you something. This is a quote from the educational director of a major options trading broker. And I've had it in here because I found it kind of, I believe it. It says the most erroneous and yet overquoted notion about options expiration is that 70 to 80% of options expire worthless. If you ever hear that in a seminar, and if you attend more than one, I guarantee you will hear it, get up and leave. Now, I'm not advocating, that if you hear something like that, you actually get up and leave. You want to hear what everybody's saying, and then evaluate it on your own. But this is how prevalent this kind of information is. Now, here, if we take a closer look at what's actually going on, the study only looked at options at expiration. Options that were closed prior to expiration weren't included in the study. And at expiration, options are worth either zero or parity. Well, the ones that are zero, you can't sell them. You kind of have to. Excuse me. You have no choice. Those options can't be sold. So it doesn't, the argument doesn't really hold water, at least the way I think about it. And here we have the first two paragraphs of an article. This was in Investopedia. Actually, you could just look it up. I don't know if, it probably doesn't make sense for me to read it to you, but it's basically saying that option sellers have a trading edge. And it's all based on that original study that is being misinterpreted in a relatively big way. Now, as more proof of that, let's take a look. The options that aren't worthless will be exercised, and the trader will end up with a longer short stock position, right? In other words, if you hold an option to expiration and you don't do anything with it, we have automatic exercise now if the option is in the money by a penny or more. That number used to be a lot higher, but the problem was there were people who would have options that were in the money. They'd go on vacation. They'd forget to tell their broker to exercise them, and because they were away, maybe they didn't sell those options, and they'd end up, even though it was in the money, let's say for 25 cents, they'd end up expiring. Well, the SEC didn't like that, and eventually they kept lowering the threshold for the automatic exercise, and now it's a penny. But here's the problem. The problem is that many traders either don't have the capital or for other reasons, they don't want a stock position. So what do? They close their options position prior to expiration, and those options weren't included in the study. Now, when you think about it, I'm going to just show you something. If we have, yeah, see if I could draw this. So we have calls on the left, puts on the right, for example, and at the monies are right over here. What ATM? Whoops, it's a thick pen. So on the call side, lower and strikes are over here. So these calls are in the money. These calls, these puts are out of the money. And here it's the opposite. So the higher strike calls, these guys are out of the money, and these puts are in the money. Well, think about it. When a new options expiration comes out, the ones that trade the most are the out of the money options. So there's going to be a lot of trading for these out of the monies and a lot of trading for these out of the monies. And there'll be significant trading right around at the money, both on the put and the call side as well. Well, you're going to have, approximately an even number. I mean, one side, if people are leaning heavily on the put side, all right, there'd be more puts. If they're leaning heavily on the call sides, there'd be more calls. But when you get to expiration, one side, assuming the stock hasn't moved much for illustration, one side is going to go out, but there's still going to be a ton of in the money options that are left. Okay, so those have to be closed. So it can't be that just one side would end up. Oh, excuse me. You're going to end up with the same number of puts and calls, and one side is going to end up being exercised, and the other side is going to end up expiring worthless. There's no other choice. Options at expiration are worth one of two things, either zero or parity value. All right, now this is, to show you, this just isn't my thing. Here's the OIC. This is our industry council. They have a list, and it would be educational for you to take a look at the list of option myths that they have. And their number one myth, there's a list, I don't know how many there are now. At one point there were 10, I think now there might be more than that. But this is what it says. Selling options is the best way to make money since 90% of options expire worthless. That's the option myth. And the 2008 option statistics show 12% are exercised, 69% are closed prior to expiration, and it's really only 20%, or there are 20% that expire worthless. And this is from the Options Clearing Corporation. They don't have a bone to pick either way. They're just trying to give you information. And so this is what they're saying. So when you hear that 80, 90%, whatever the number is, expire worthless, you have to be very careful. I've done, over the years, I've done my own kinds of studies. And these are the ways to close an option position. You could cover, meaning buying back if you're short or selling it. And of those options that are opened, it's probably about half, maybe a little bit more than half. Early exercise, well, not that many. A lot of people don't want to have the stock be long or short stock. They could exercise at expiration. That's small percent, 9 to 12%, about the same as the early exercise. Excuse me. And then you could have those that expire worthless. And I'm a little higher maybe than the OIC, but again, somewhere around 20 to 25%. That makes sense. But 80 to 90%, no, thank you. All right. So could we draw conclusions from that? Yeah, that it's probably a very misleading statement that tends to get used a lot, particularly by people who are selling programs, I guess, to entice you to sell options. Does it mean that buying options is better? No, of course not. We know better than that, but let's just think about it. So the bottom line here is that there's no valid reason to be a seller versus a buyer. For any particular trade, you have to evaluate it. And yeah, I have this kind of, I don't know if it's a theory, but the way I think about things, if your only strategy is to sell options, I call that a trade orientation. And I have a whole list of what I call trade orientations. Um, Other examples might be something like this. Only doing credit spreads. If you say that's all you're doing, I'm only doing credit spreads, or I'm only doing call calendar spreads, or I'm only trading earnings, or I'm only doing butterflies. Only doing and then fill in the blank. That's a trade orientation. What do I have to say about trade orientations? Well, in my opinion, trade orientations are bad. They could work, for a short period of time, but they're not going to work forever. The market is complicated. It's efficient. It's complicated, and I don't think there is a trade orientation that's always going to work. People have them work for a while, and then they kind of fall apart. The way I look at it is that professional traders should look for, as opposed to a trade orientation, I call it a price orientation. Meaning, what I mean by that is if you give me a particular trade, at some price I would buy, I'd be a buyer. And at some other price I would be a seller. And maybe at other prices in between, I might just walk away and say I'm not interested in that trade. So that's, the bottom line. There's a time to buy options, buy them, and a time to sell them. And it's really knowing the difference which will make you profits. Now there's, in terms of actually how do we go about doing it? Well, I showed you one way. We could look at mathematical expectation. That's the amount of edge in a particular position. And there's lots of ways to determine if there is an edge. But that's not something that I'm going to talk about today. But just be aware that selling, at least from my perspective, is not always better than buying. And by the way, just as a final thought on that one, I sell a lot of options, but I make sure that when I sell them, volatility is relatively high, and I believe that it's going to be coming in, meaning going down. But I also buy a lot of options. I tend to buy long-term, low volatility straddles, and that's something I go into a lot of detail in my mentoring program. But anyway, let me tell you now, and I'll answer some questions. There's a few things I want to show you. Here are the answers to the brain teasers. I know a few people have submitted answers, and if you got 2 of them correct, I'll be sending you an email later on or tomorrow at some point, providing the prize that you've won, which is a 3-month subscription to our flagship newsletter, The Options Strategist. And if you have questions, by the way, about the brain teasers, you could send me an email. I'll be happy to go through them with you as well. Sometimes I end up getting more questions about the brain teasers. Go figure, right? All right. And then let me just tell you about the company, McMillan Analysis Corp. You probably have heard of Larry. He wrote the book. He's got 4 books. But we provide many products and services. We have trade advisories. We do money management for those who don't want to trade options on their own. And we have a lot of educational material, including the books. We have CDs. We have a bunch of things. What I do in particular, I do consulting projects to anyone who's interested in institutions, hedge funds, and individuals. And I also run this one-on-one mentoring program. And if you're interested in either of these 2 categories, actually in any of these things, I'll direct you to the right person. But if you're interested in either of these 2, the consulting or the mentoring, feel free to call me directly or send me an email. I wanted to thank everybody for spending time with me. We have some very discounted specials. The Option Strategist newsletter, that's the one that I'm giving the prize winners 3 months of. But um, we have, and it's the actual price is more than this. But for 6 months, you could take a 6-month trial for $99. We also have a 16 seminar home CD course. We used to send out a big box of CDs. Now I think we've come into the 21st century a little bit. We do it by video downloads. So you can put it from one computer to another. They're audio and video. And then we have intensive option webinar that Larry put together, volume 1. We're discounting to $99. If you're interested in these, just contact me for additional information. I'll tell you how to get them. Oh, excuse me, I almost forgot. This is a great program that we have. It's our tuition reimbursement program. Students that enroll in our mentoring program receive rebated commissions from TradeStation until the cost of the mentoring is recovered. So think about it. I came up with this idea a number of years ago, and TradeStation's been a great partner of ours in this respect. It's a win for TradeStation. They're getting trained customers who want to trade options, who love to trade options, who are going to make money, hopefully, right? Trading options. It's a win for us because we advertise it and we get more students. And it's a win for the student because they're basically getting free, or at least, depending on how much they trade, very discounted mentoring. So it's a win-win-win, and it's great of TradeStation to participate in this program with us. If you're interested in more information, you could email me, stan@optionstrategist.com, or just call me, 973-362-4558. I think that's, yeah, here's more contact information. Let's see if I have a page. All right, here's the final page. The phone number, the email address, and then if you're interested in the mentoring, consulting, or the special deals that we have, just get in contact with me. Now I see there are some questions. Let me just see if I could go back and well, someone says, can I display the questions again? I guess well, we've already gotten past that point. Let's see. Are you mainly selling spread on selling premium trades? Yeah, for me, the answer to that is definitely yes. I like to trade spreads. Actually, I don't really buy individual options or sell individual options. Generally, I mean, most of my trading is spread trading. Someone said I sound excellent. No, I'm kidding. They're saying the sound is good. They hear me, I guess. What was the delta? And okay, I'm not sure what that refers to, Bart. But if you send me an email, and put it back in perspective, I'll get back to you. And then yeah, and somebody made the comment. Michael did. I don't like to give last names or anything, but Michael made a very good comment here. Nobody knows how they'll react until they actually experience it. And I probably should have even said that, Mike, because you're 100% correct. Once the market starts going against you, people tend to panic, and unless you have some experience. This is going back to that SPX situation I showed you. You're right. People don't know what they're going to do. And it's hard to prepare for that, because once you're faced with a situation where if you close the trade, you set yourself up for a large realized loss, some people tend to panic in that situation. They don't consider a loss realized unless they actually close out the trade. But an unrealized loss, is going to become a realized loss if you don't do something about it. Let's see. Bought them back. Okay. Somebody's saying they were short Netflix and bought them back at a profit. Good, good. Yeah. Someone made a comment, they won't get to expiration, they'll die of a heart attack. Yeah, that We don't wish that on anybody, but okay. Yeah, well, let's see. There's a real long one. Huh, I'm not sure what this one is. Um, okay. Uh, and if anybody, if I don't mention one of the questions, please just send me an email and I'll be sure to respond to you. Oh, and then we have a bunch of answers to the brain teasers. Selling from. Yeah. Okay. Here's now. So I'm not going to mention his name, but it says that a guy out there is selling a program saying that the premium that you get when you sell an option is yours at the moment of selling. Can you explain, please? That's a very good question, Francisco. And I've seen that, and it really it drives me crazy. Or some would say crazier. Um, when you do sell an option, the money comes into your account, and that could be used for other purposes. It helps offset the margin that you have, and then there's going to be leftover that you could use for other reasons. But you don't keep it. You now have a short option that you're going to have to buy back. And I know exactly who you're talking about. I've seen his presentations a number of times. He'll show a high school kid and teach a high school kid how to sell options, and then show how you could buy them back. Well, he doesn't show how you buy them back. He shows how the value of the account increases by the amount of the sale at the moment that you sell the options. And that's correct if it's not reflecting the fact that you have to buy these options back. And the problem is sometimes you have to buy them back at the price you sold them, or sometimes at a lot more than that, and you end up with a loss. Remember this, a completed transaction is a buy and a sell. But in our crazy world of trading, we could sell first. But still, to be a completed transaction, you need the sell and then the buy. And so the transaction isn't over until both of those have occurred. So be careful when people tell you that, yeah, you sell this option, you bring $10 into your account. Well, you do at the time, but you now have to buy it back, and you don't know what you'll have to pay for the option to close the position. Okay, I think well I've gone through my hour. Um, if anyone has additional questions, feel free to send them to me or give me a call. I told you I like talking to option traders, so it's not a problem. Thank you very much for listening. I appreciate it. And again, thank you TradeStation and Don and Chris and the people that I deal with there. Thank you for allowing me to put my presentation on.